Ladies and gentlemen, please welcome the Chief Executive of Jersey Finance, Geoff Cook.
So I'm going to begin by reprising where I think Jersey stands in the current environment in international finance centres, the context that we're operating in, and try and bring you up to date on what's been happening in Jersey over the last 12 months. And by doing that, prime the keynotes and the panel sessions that will follow. So here I have an extract from the IMF World Economic Outlook. And you can see from this that the nascent recovery in the world is strengthening, it's taking root. And the numbers seem to strengthen almost by the week. Here we have the world economy figures in white, the advanced or developed country figures in the red, and the emerging markets and developing countries in the grey. And as you can see, the red advanced economies are almost doubling in terms of their anticipated growth rates in 2014 and 2015. Long run average for Europe is about 2.5%, so returning to some kind of economic normality. And despite the turbulence in the developing countries, still turning in growth rates anticipated around 5, 6, 7% or thereabouts. So a strengthening world economy. In fact, just today, yesterday I think it was, the CBI announced that their predictions for the UK have been uprated yet again, and they're predicting 3% growth for the UK going forward. What does all of that mean? Well, it means a lot more global trade. It's interesting that throughout the economic slowdown, the last sort of 7 to 10 years, global trade has kept increasing, even through the slowdown years, and reached record levels. And that has a lot of upside for wealth creation, for economic prosperity, and a lot of buoyancy and positive benefits for the advisory community in this audience. But we continue to live in a world that has a lot of political risk in it. A lot of events, and we're seeing that already today. The news was dominated this morning by the AstraZeneca Pfizer proposed takeover. And nothing's happened there yet, but already it's a controversy. So political uncertainty is an enduring risk in the world that we face. But the impact of trade, I think the mega trends around the world, the impact of trade is that it's driving wealth creation. And again, I think a very interesting fact is that during those long, slow years, the last 10 years, 7 of the last 10 years have been low or slow growth. During that period, world income per person still rose 60%. And the middle classes consumer classes are estimated to grow from around 1.8 billion to over 3 billion by 2025. That's lots more people coming into the consumer classes, developing economic activity, developing trade, developing purchasing power. And all of that means there's going to be an overriding need for new infrastructure investment as cities urbanize, as there's a continuing move from agrarian lifestyles to city-urban lifestyles. That will drive a huge demand for infrastructure development and cross-border financing, both in the developed and developing world. Just again this morning, the Mayor of London announced the need for a further 30 billion of infrastructure spend on London's roads. What that actually means is there's a $50 trillion shortfall by 2030 of the financing needed for that infrastructure investment. So there's a need to put capital to work. And capital that's been on the sidelines for many years is now being invested. And we've seen a real surge in Jersey in our funds industry recently as a consequence. What does all that mean? Well, it actually drives opportunity, I think, for the private client world, because business people, many of them, and particularly outside of Europe and the US, are family entities. They're private individuals with significant business enterprises. So if the world economy really picks up, they will pick up with it. I've got some figures here from the Capgemini Lorenzo curve analysis, 2013. It's a complicated chart, so I won't go through it in detail. But what you can see is in 2008, the second column, we had the dip from the financial crisis as investment values dropped. But as you can see, over the years, that's recovered, and the projection for 2015 is that investable liquid assets for high net worth investors over $1 million will rise to $55 trillion by 2015, so significant growth in the wealth management market. And it's not just in the major domestic economies. This is, again, a slightly complicated slide. This was produced for Jersey Finance by McKinsey. We undertook a strategic review in 2012, 2013 with McKinsey, and laid out a blueprint for the development of the Jersey Roadmap over the next decade. This is part of the research from that has helped us prioritize market development. I'll just try and explain it to you. If you take the first line, reading across the top, Asia, you have in 2012 estimates of onshore and offshore wealth. And by offshore, I simply mean you have your money in a country other than your country of residence. So it can be any country. And you can see there in 2012 in Asia, $13.2 trillion and $2.3 trillion. But go forward, fast forward to 2016, a couple of years away, that's estimated to grow to $20.3 trillion onshore, largely as a result of the powerhouse Asian economies, but also our world, the offshore world, growing to $4.7 trillion. And what McKinsey said to us is if you keep in step, if you modernize, if you keep in step with developments, if you compete, your offering is global and it's globally attractive. And that has driven really our market development strategy. The compound growth rates there, the far two right bubbles, are 11% per annum for Asia and 20% for offshore. As you can see, Western Europe, North America a little bit slower, but many other parts of the world, particularly developing countries, growing very fast in wealth accrual terms. So how are we seeking to capture that opportunity and make ourselves attractive to that marketplace for the management and stewardship of that wealth? Much of it developed in countries that have a history of political instability, where people look for a safe harbor. Nothing to do at all with tax evasion or tax avoidance, simply about capital security and trusting somebody to help you put your capital to work. Well, we have longevity. The Jersey Trust Law is 30 years old this year, and I think a testament to its strength and attractiveness is that we're only on Trust Law Amendment number 7 after 30 years. Now, I don't think that's ho-hum and boring. I think that means that the draftsmen got it right when they devised that law, and it's the reason I think that we have the largest branch of STEP outside of the United Kingdom globally, and the reason why the Hague Convention on Trusts is based on the Jersey Trust Law, which has been widely copied by emerging market jurisdictions. But we've developed too our proposition to make it attractive to the international investor, and we were one of the very early jurisdictions to develop a common law foundation. Sounds a bit like an oxymoron, but we've borrowed the best from the civil law jurisdictions, added what we do well, stirred that recipe together, and come up with a common law foundation. There was some skepticism about it, I think, when it was initially launched, I think particularly with some of the dyed-in-the-wool and entrenched trust lawyers in London. But it has taken off, and it's had great appeal to the Middle East in particular, and to other parts of the world where the common law system is perhaps less familiar. Here you can see that our total foundations registered now are pushing up towards 300, and that early mover advantage has helped us because it's been copied and simulated by Guernsey and Isle of Man since, but we've managed to develop that first mover advantage. The work we did with McKinsey and some of the research that I'm sharing with you has informed our market development strategy, and we've pushed out into the world to take our offering, what's traditionally European, into a global marketplace, a global platform. And these are our priority markets. So we are not turning our back on London or the UK or Western Europe. We bring a lot of capital from different parts of the world, and the investment destination for much of that capital is Europe. London is still the GHQ of financial services globally, despite the Global Financial Centres Index, and will continue to be so, in my opinion. But we are pushing out into the world where we think wealth is going to be created above trend, and we're capturing that wealth. So this slide that we did with capital economics gives you an indication of where some of this money is originating from. I'll reference the title in a moment, but just as you can see, it's a very global footprint now of business originating from many parts of the world, using Jersey as a safe harbour and steward for efficient investment, efficient capital allocation. The reason I put the title on there is it's partly to prime our debate later on. Much of the NGO community worry about that money coming out of developing countries. They feel that if money comes out, it's not available to develop the local economy. That's a natural and a valid concern. But one of the problems that developing countries have is they're generating wealth at a rate which cannot be accommodated in their own economies. And if it is all invested there, you'll have asset bubbles, you'll have stock markets going through the roof, and there just aren't the opportunities. So having a safety valve, allowing them to diversify their investment portfolio, take stakes in other parts of the world, pulls their economy up generally and wealth levels generally. And that's the kind of business we're interested in doing with the developing world. And it's not one way. I think often what is ignored is the money flowing into continents like Africa. As you see here, Jersey carries more capital value into Africa than it brings out. So it is very much a two-way activity. So I'd like to focus now on two large themes. I've kind of tried to give you a backdrop of where we've been in performance of the jurisdiction, in the proposition, its attractiveness to you, the markets we're involved in. I'd like to talk now about two big themes to try and set up our panel sessions later. The first is trust, and the second is transparency. Now, some of these images may be familiar to you. The Jimmy Carr episode a few years ago now, more recently Chris Moyles, and in the news just this week and over the weekend, Gary Barlow's tax planning affairs. So the focus on celebrities and wealthy people has arguably never been more intense. And their affairs and the whole issue about wealth and social equality is a very prominent issue, and one that we need to address and be cognizant of, and indeed be sensitive to. It was interesting, I think, in the two gentlemen on the right, Monsieur Hollande you'll recognise, the other gentleman you may not recognise, Monsieur Cahuzac. He was the French budget minister who was responsible for bearing down on tax evasion in France, but was unfortunately found to have 600,000 euros stowed away in an account in Switzerland that he'd never declared, which caused something of a contretemps in the French government at the time. I was rather amazed that the French media, instead of jumping on planes or jumping into the car and driving to Geneva, instead came to Jersey. And I had to point out to them that actually Monsieur Cahuzac had no business in Jersey, never had. But it's symptomatic, isn't it, of the mythology that builds up, unfortunately, around centres like ours, and the inherent prejudices that can get entrenched. And then we've had, of course, the multinationals, the Google, Amazon, Starbucks, and we've had some more in the headlights recently too. Some current examples. I don't know if you recognise these gentlemen. This is Messrs. Dolce and Gabbana, and they've recently been caught in Italy for tax fraud, and principally for the use of a Luxembourg company. And I don't know the details of the case. They've been fighting this for a while. They've just been convicted and sentenced, and they're appealing. And it principally revolves around the use of a Luxembourg company, which I suspect is some kind of IP cross-border tax mitigation exercise. But it does just show you how deficit nations with significant financial problems are bearing down on their citizens with this huge focus on tax and the activities of the wealthy. Interestingly, the reaction of Prada was to fold their Luxembourg company, repatriate the value to Italy, and pay 10 years of back tax voluntarily. So clearly these issues are having an impact, but brings into question, doesn't it, the rule of law, certainty, people's motives, and then we move into this difficult territory of what is socially responsible, what is moral, and I hope we're going to be able to debate that in our panel sessions later. Bang up to date, right to today. If you listen to the Day programme this morning, one of the headline stories was the Pfizer-AstraZeneca takeover. Nothing's happened yet. One large American group said it's interested in making an offer for a British/European group. No official offer has actually been made, and yet already both companies are in the dock for all sorts of things, but potential for tax planning, tax mitigation, jobs, concerns. It just shows how focused the current agenda is on cross-border finance and the behaviour of business cross-border. I took an excerpt here alongside this slide from the Financial Times Populace Survey. Almost two-thirds of voters, including half of Conservative supporters, want the next government to be tougher on big business. And there are widespread concerns over high executive pay and ethics. So this is the environment that we're operating. I think we have a trust deficit in business that we need to recognise and need to act on. John Cridland, I'm fortunate to be a member of the CBI Trade Association Council, so I meet with people like John Cridland fairly regularly, and we talk about these things, talk about the business agenda. And John recently said, at a time when the business climate's getting better, which I think it is, the political risk for business is heightened. I think that's right too. We've got the European elections coming very soon, the European Parliament. We've got a British election coming very soon, and these are feverish times for the political climate, and it's when things can happen very quickly on the business agenda. I'm going to conclude now by just talking about transparency very briefly. You're going to get a much more detailed address on this and a panel session. But just to kind of give you a brief overview of the subject matter, we've dealt with trust, going to deal with transparency and Jersey's current position. It's a very topical subject. In the early 2000s, late 90s, early 2000s, we had the advent of on-request information exchange. It was followed by the European Savings Directive. Then we had US FATCA, which is a bit of a game changer. Then we've had UK FATCA and lots of sort of copycat initiatives, the G5 initiative, and now we've got the OECD multilateral program. Alongside of that, we had ESD enlargement, and there's a very topical debate right now in London, in the UK, which I think will feature at the G8, on the level of disclosure of public companies and public company and trust registries. And overarching all of that, we have the OECD's base erosion and profit shifting program and the recent announcement of the common reporting standard of automatic exchange of information. You're going to get much more topical detail on this in a few moments. I just wanted to let you know where Jersey stands on the transparency agenda. We introduced all crimes legislation in the late 90s, over 15 years ago. What that means is if you aid and abet somebody to commit a tax fraud, and non-disclosure is a tax fraud, then that's a criminal activity, and you will be pursued, you will be prosecuted, and you can go to jail. And people have gone to jail in Jersey for assisting people in tax evasion. That's backed up by a suspicious activity reporting regime, and all of our corporate service providers are regulated. We're unusual in doing that. We have a financial crimes unit which underpins all of that, and then of course the transparency agreements and the commitment to working with people like the Financial Action Task Force and Moneyval on fighting financial crime. We're one of the very few jurisdictions in the world to capture beneficial ownership information on a corporate register. We already do that. And we also hold it on the files of our corporate service providers, and it's subject to inspection by our regulatory authorities. So we know who owns the money in Jersey, and if they commit wrongdoing, if it's criminal or it's illicit, and we become aware of it, we have means to act and bear down on that. And a system, I think, that's more efficient than just about anywhere else in the world. We're an early adopter of the OECD multilateral program. 44 countries signed that initially. The number's already up to 60, and it includes significantly not just places like Jersey, but Switzerland, Singapore, and the major nations. So that's what we've done about transparency, to kind of keep up with the program. But we still do have a commitment, both through our data protection laws and through our common law, to legitimate privacy, what I call compliant confidentiality. Now, we've realized that over the years it's not enough to have a strong regulatory track record, that we have to persuade particularly the political community and the policy influencer community of our value, that we're not kind of clipping a coupon off as value passes by, we're not eating somebody else's lunch. So we commissioned a study with Capital Economics in 2012-2013 to work out what is the value of our contribution to the United Kingdom. Because contrary to the opinion of much of the popular media, we have very little British domicile residence business. Most of our business in Britain is either non-domicile or it's international business cleared through the UK. What that study uncovered was that we provide 120 billion or so of liquidity into the UK banking system of long-term money that can be lent out on mortgages and lent to small business, supporting the real economy. We discovered we generate £9 billion of GVA, and we support 180,000 jobs. And I think the most remarkable statistic is we provide £500 billion of foreign direct investment. The bulk of that money is sourced from all over the world, ex the EU, but the bulk of it invested in Britain or the European Union. And when surveyed, 84% of our member firms said that their clients had indicated to them if this efficient capital allocation and pooling vehicle was not available, that money would not be in Britain. It would be somewhere else. So we're building at the moment on Jersey's value to Britain. In early June, we'll be launching a new report called Moving Money, and that examines the role of international finance centres such as Jersey in their role as efficient capital allocators, pooling money, taking money that's been taxed in its home jurisdiction, pooling it with several different nations and entities, and then investing it in a destination country where it creates wealth and economic activities taxed again, and then a return to Jersey, back to the investor. All we do in terms of tax neutrality is avoid that third layer of unnecessary taxation. And we're also conducting a major study on Jersey's value to Africa, and I expect that to be concluded by June too. So we're very committed to evidence-based advocacy. There's a lot of debate in the system about trust, transparency, and illicit capital. Much of it is based on estimates and guesstimates. We're basing it on real facts and evidence.